Welcome to the Daily Drawdown, where AI capital, market concentration, and real-world constraints drive the tape. The signal right now is simple. Money is pouring into AI faster than infrastructure, regulation, and market breadth can keep up. That gap is creating the biggest opportunities and the clearest fault lines. Berkshire Hathaway made two moves that matter for very different reasons. First, it agreed to buy homebuilder Taylor Morrison for about $6.8 billion in cash, or roughly 72.55 cents a share, with enterprise value pushing closer to $8.5 billion including debt. That fits Berkshire's existing housing stack through Clayton, building materials, and mortgage channels, and it reads like a patient capital bet that U.S. housing is at or near a bottom, even with 30-year mortgage rates still above 6.5%. Second, Berkshire bought $10 billion of Alphabet stock in a private equity raise tied to an $80 billion offering, taking its total Alphabet exposure to roughly $30 billion. What matters there is the signal. Berkshire is endorsing Alphabet's cash flow durability, and the structure raised a bigger question about whether hyperscalers may tap private equity more often instead of just issuing debt. NVIDIA's latest announcements widen the fight from cloud accelerators into CPUs, PCs, and edge inference. The company rolled out ARM-based CPU and superchip initiatives for data centers and Windows PCs, pairing custom CPUs with Blackwell GPUs to push AI workloads onto laptops and desktops as well as servers. The practical implication is that AI demand may no longer be confined to giant cloud clusters. If local inference takes hold, companies will need hardware for personal agents, smaller models, and device-side processing. That broadens the AI spend map and pressures Intel, AMD, and Qualcomm at the same time. The market reaction made that clear. NVIDIA added enormous value on the back of the launch, helped by claims around performance and lower cost per token, and by analyst estimates that its CPU revenue could become material within the next few years. The edge story matters beyond semis. If more inference runs locally, software pricing could shift from pure usage-based models toward a mix of seat licenses, device bundles, and personal agent subscriptions. That would spread AI economics beyond the hyperscalers and create new demand for PCs, enterprise endpoints, and on-device tooling. What to watch next is whether developers actually build for this model at scale, because the hardware story only sticks if software follows. On infrastructure, the numbers keep getting larger. The Michigan campus tied to Related Digital, Oracle, and Stargate has been described around $16 billion before equipment, with 1.4 gigawatts of power. Once you add GPUs and networking, a single site can push toward $30 billion to $40 billion. OpenAI's broader Stargate ambitions have been framed in the roughly $45 billion twos, and SoftBank's Europe commitment in France came in around $75 billion. Why this matters is financing. These projects need stacked capital structures that blend bonds, private equity, and tenant credit, and they depend on power, water, utility coordination, and in some cases, behind-the-meter generation. The constraint is no longer just chips. It's electricity, cooling, memory supply, and who can underwrite the build before revenue fully arrives. That funding need is part of why Anthropic's confidential IPO filing matters, and why the market is already debating whether OpenAI follows soon after. The exact valuation snapshots have been inconsistent, but the core point is consistent. These companies need tens of billions of dollars to fund training and inference capacity, so going public looks less like an exit and more like a financing event that could reshape market liquidity if several huge, low-current earnings AI names hit public markets in close succession. It also adds pressure to market structure. Shorter lockups, directed share programs, and big post-IPO debt needs could all increase volatility for new listings. The bullish case still has substance. Token prices are falling, but usage growth is outrunning those price declines in many cases, which supports more spending on compute. The problem is that stock prices may be moving faster than earnings can justify, especially with parabolic moves across semis and a growing queue of richly valued listings. That is why the dot-com comparison keeps coming up. Some say this cycle is much bigger. The risk case is that it still follows a classic bubble pattern if capital markets stop absorbing supply. The broader market is sending a mixed message. The S&P 500 has put together a long winning streak, but those runs rarely continue forever, and several warning signs are building underneath the surface. Credit spreads in lower quality debt have widened. The rally has been narrow, and leadership remains concentrated in mega-cap growth and AI-linked names. There is rotation into second-order beneficiaries like power, materials, and selected software, but plenty of sectors are lagging, including regional banks and parts of retail and housing. If the semiconductor to software leadership ratio weakens further, that could be an early sign that this phase of the rally is tiring. HPE's latest results reinforced that enterprise AI demand is showing up outside the headline names. Server bookings were strong enough to lift guidance and drive a major move in the stock, with AI systems and Juniper integration helping the story. But management also flagged the issue. Everyone is dancing around. Memory remains tight. DRAM and NAND pricing are still elevated, which is good for memory suppliers but can squeeze system margins and slow deployment if component costs rise faster than selling prices. That makes memory one of the key bottlenecks to watch through the next leg of AI infrastructure build-out. Outside AI, housing, and energy remain the clearest macro swing factors. In housing, consolidation is accelerating, and Berkshire's Taylor Morrison deal underlines that scale is becoming more valuable. The key variable is not just mortgage rates, it's mortgage spreads, because so many existing homeowners are locked into older, low-rate loans. In energy, oil jumped hard on Iran headlines, with traders reacting to any threat around negotiations and the Strait of Hormuz. The takeaway is that even without a full disruption, partial or intermittent shipping risk can keep a geopolitical premium in crude and feed inflation sensitivity back into the broader market. First, consumer spending may be less healthy than the headline data suggested. Large tax refunds and heavy BNPL usage appear to have supported first-quarter spending, which means demand could soften once that tailwind fades. Second, regulated prediction markets are becoming a real market structure story. Kalshi is pushing further into political indexes and perpetual products while fighting state-level legal challenges. And the bigger issue is whether federally regulated event markets can pull volume back onshore. That's the setup for now. Capital is chasing AI at historic scale, but the choke points are multiplying in power, memory, liquidity, and market breadth. You've been listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.